Good morning, traders, and welcome to BCR's morning market analysis. Let's take a look at the key moves shaping the markets this morning. First up, let's have a look at the US dollar. The DXY fell to 99.41 on Thursday, marking 4 straight days of losses and the lowest level in nearly 3 weeks. Markets now price in an 85% chance of a 25 basis point Fed rate cut in December, which is up sharply from the 30% number last week, with 3 further cuts expected by the end of 2026. Expectations strengthened after reports that Kevin Hassett is the leading candidate for the Fed chair, aligning with President Trump's preference for lower rates. Despite stronger initial jobless claims and durable goods data, the dollar weakened broadly, especially against the New Zealand dollar and the Australian dollar. With Thanksgiving and Black Friday reducing liquidity, the index has broken below its recent upward trend line, but it's still holding key levels at 99.36 and the psychological level of 99. A recovery above the 200-day SMA at 99.71 and the psychological 100 level would be needed to shift momentum. But fundamentals, rate cut bets, easing geopolitical tensions, the US government shutdown, and record debt continue to pressure the US dollar. Next up, let's have a look at crude oil, WTI, which traded around $59 on Thursday, rebounding slightly as markets weighed over supply risks against progress in Russia-Ukraine peace discussions. US crude inventories rose by 2.8 million barrels last week to 426.9 million, which is far above expectations, as analysts warn that the market is heading towards a significant oversupply. Rising rate cut expectations have provided limited support, but unless peace talks collapse, the broader risk remains tilted to the downside, with a potential move towards $55 if negotiations conclude successfully. Technically, the current stabilization is more equilibrium than reversal. Inventories, weakening demand, and potential Russian supply increases continue to exert pressure on WTI, while thin Thanksgiving liquidity may amplify volatility. Prices are likely to remain within the $57 to $60 range unless there's some catalysts that emerge. Next up, let's have a look at gold, which traded near 41.60 on Thursday after extending gains to a more than 1 week high, with the probability of a December Fed rate cut jumping to 85%. Gold remains supported despite a stable dollar. Although initial jobless claims fell, economic uncertainty continues to underpin gold's safe haven appeal. Support lies at 41.32 to around 41.30, with deeper downside levels around 41.4 and 4100, which is a psychological level. The 20-day SMA is around 40.76 and the October trend line at 40.40. A break below these areas could turn short-term bias bearish. On the upside, 4174, 4173 region acts as initial resistance, followed by the psychological level of 4200. A strong break above that could open the way towards the monthly high near 4245. Next up, let's have a look at the Australian dollar, which rose for a fifth straight session on Thursday, supported by rising expectations of a December Fed rate cut and stronger Australian data. Q3 private capital expenditure surged 6.4%, beating 0.5% expectations, while October CPI climbed to 3.8%, reinforcing RBA's caution as inflation stays above their target. The pair traded around 65.30, reaching a 3-week high. Price has broken above the 20-day SMA at 65.04 and the psychological level of 65 cents, strengthening its short-term tone. Resistance sits at the 50-day simple moving average at 65.33, followed by 65.80 and the psychological level of 66 cents. On the downside, support starts at the psychological level of 65 cents and deeper levels around 64.89 and the 200-day simple moving average at 64.62. Well, that's all for today's morning market analysis. We'll continue monitoring developments in the markets. As always, manage your risk and happy trading.